We'll go ahead and get started here. 10 o'clock. Want to be mindful of everybody's time. So thank you all so much for joining us this morning. We are excited to be here again for one of our quarterly compliance roundtables. I'm going to talk about some recent happenings in the world of fun world of regulatory compliance that we live in here. I'm joined by Vanessa Carter this morning from Woods Rogers Vandeventer Black. Vanessa works with Jay Spruill and some of the attorneys there. She's one of the ones that handles the questions that come in from the compliance hotline. As you all know, as league members, you have access to the compliance hotline and our HR hotline through Woods Rogers. Random questions, come up, compliance related. Feel free to shoot out to them. Feel free to reach out to me. Whatever works for you guys. We have, good resources for you to get you the information that you need. So this morning, and Mary, if you could go to the next slide, I'm going to talk about some recent kind of things coming down from NCUA, from CFPB that, are going to potentially impact us here. And then Vanessa is going to talk a little bit about some of the stuff that she's seeing coming through on the hotline, some questions that credit unions are having that we think could be beneficial for everyone. All right, Mary, can you go to the next slide?
Did I go too far?
Oh, yeah, sorry. Go, I think it, go back up. Actually, no, I think this is good. Sorry, there may just be a delay on my end. I'm seeing NCUA changes to call report for $1 billion plus credit unions. Everybody seeing that with the table? Okay, good.
Yep. Yes.
Okay. So we start with our friends at NCUA, and NCUA has been in a little bit of a calm before the storm, I think, is the best way I describe it. We just went through this turnover at the board. Rodney Hood's term expired. There was a little bit of a delay in getting the next person, but Tanya Otska has come on as that third board member. So I think there was, they haven't taken a whole lot of action in sort of that period where they knew Rodney was going to, be leaving the board and Tanya be coming in. Tanya was sworn in January. And so I think now we're kind of ending that sort of calm before the storm period. Tanya Otska gives Chairman Harper a second Democratic vote on the NCUA board, whereas before he had 2 Republicans as a part of that 3-member board. So in terms of his priorities and what he wants to achieve in his time as chair of the board, he has a much more open path to do that now. So I think going forward, we're going to see a lot more in the realm of consumer protection. He's talked about wanting to have separate consumer compliance exams in addition to safety and soundness exams for credit unions. So 2 exam scores and instead of 1, what could possibly go wrong there? He's stays on the path about third-party vendor authority. And I think these things and others are going to be real priorities for him now that he has the makeup of the board that makes it a little more favorable to do that. So the first thing we've seen, really, the first big thing coming out of NCUA in this new regime is this change to the call report that's going to be coming for $1 billion plus credit unions. So normally, and y'all have seen, if you've seen the call report, line 13 in this non-interest income section, you report your fee income. They're going to have a little bit of a breakout, as you can see right below that with that A and B. So for credit unions who are over $1 billion, you now have to report your overdraft fee income and your NSF fee income. So these are going to be 2 line items for $1 billion plus credit unions that are going to be added to the call report. They're working this through the Paperwork Reduction Act. The proposal, said that this was going to come in the March 31st call report. There's not been seen any kind of final approval or anything like this. And unfortunately, the NCUA canceled their March board meeting. So it's not like this is an agenda item that they're going to be voting on, next week. They're not having a meeting in March. So we've been kind of in a little bit of a wait and see on this. It's been a very strange process, I will say, in terms of how they've gone about this. They slipped this into like an attachment to an attachment in mid-December to say that they were going to do this, and it's not exactly been the most open and transparent process. But this will only apply to you if you're $1 billion plus. And as you can see, you just have to report those two fee income levels there. And we know these are fees that have been, certainly in the scope of the CFPB as they waged their war on junk fees, and NCUA is, getting in the battle here as well. Next slide, Mary. So the amended call report instructions, if you're looking at this, your first question may be, well, what constitutes a non-sufficient funds fee? The instructions that they have don't really elaborate. They just say report the income from non-sufficient funds fees. So the NCUA, I talked to Sarah Bang, who is the policy advisor for Vice Chairman Houtman at the GAC, and raised this with her and said, hey, there's no definition of NSF fees, so our credit union is just going to kind of pick and choose their own. And basically the answer was yes. She did not seem to think it was a big deal that they did not have a definition of what constitutes an NSF fee. So they are, seem to be kind of leading it up to credit unions, at least at this point in time. Will they release some additional, guidance down the line? Perhaps. But kind of as it stands right now, it seems like, credit unions will have to sort of choose for themselves, what they are reporting as an NSF fee. I think this is a dangerous road for NCUA to go down. People call different fees NSF fees, returned item fees. The name of it can vary, and if you're leaving it up to credit unions, you're not getting consistent data coming in, which would purport to be the whole goal of this, to kind of see where things are. Next slide, Mary. So in terms of what is out there already, in terms of NSF fee definitions from other agencies, we can look to a few different places. The CFPB, in their rulemaking on NSF fees, banning NSF fees, which we're going to talk about in a little bit, they do have a definition in there about how they define NSF fees. In the FDIC call reports, they are already required to report this type of fee income on the banking side of things. So they have some definitional language about what constitutes an NSF fee. And then California in 2022, I should say, passed a law requiring the reporting of NSF fees. And as part of that, they actually did define what an NSF fee is. So there's some definitions out there from some of these other agencies and other groups that credit unions could look to in terms of what they're going to use. Next slide, Mary. So what can we expect from this? The ultimate goal of, I think the NCUA in doing this is in some sense to shame credit unions into lowering these fees and reduce their dependency on this type of fee income. So in 2022, California passed a law, I referenced this, that required state chartered banks and state chartered credit unions to report their overdraft and NSF fees. And the law says that the state regulator will release a report and release this data to the public on an annual basis. So this data gets put out by the state regulator, and we see some headlines pop up, like what you see there on the right. Credit unions are making money off people living paycheck to paycheck. And the article really dove into, highlighted some credit unions who were earning more on their overdraft fee income than their entire net income for the year. One, I think, was at 140% of their net income. That was their revenue from overdraft fees. Not everybody's like that, but we know, headline is a headline. And so I think, if we look down the line in the future, this is on call reports. Call reports are publicly available. It's only a matter of time before we see, headlines, coming in from this about, about credit unions, large credit unions and their overdraft fee, revenue. Of course, they coupled it with the Golden One Center in Sacramento. The Golden One Credit Union has the naming rights to the stadium. They're a large credit union out in California. So I think your takeaways, for you guys, if you're over $1 billion, I think be on the lookout for that call report change that is going to be coming. Our indications from NCUA, or that's going to be coming with this March 31st call report data. Decide on your NSF fee, definition and how you're gonna report that. And if you're under $1 billion, we certainly have seen this in the past. They'll set a threshold for $1 billion, and then in the future they say, hey, this seems like a good practice. We're gonna open this up, extend this to credit unions of all asset sizes. So don't think that just because you're under $1 billion today that this isn't going to apply to you, tomorrow or some point down the future. So you may want to run some reports, see where you stand in terms of what you're earning from overdraft revenue, what's you're earning from NSF revenue, specifically as a percentage of your total net income. And kind of see where you stack up. Always good to just be reviewing your fee income, status, your schedules, and see how that looks. So, like I said, with NCUA, I think we're going to be seeing a lot more coming down the pike soon. We're kind of leaving this calm before the storm. I think it's going to be a really busy year for them, and we'll keep you guys posted of what we see coming down. Any questions on NCUA call report changes before we turn our attention over to the CFPB? You can feel free to unmute or drop something in the chat, whatever works best. All right. Well, I'll try to keep an eye on the chat, but we'll turn now to our lovely friends over at the CFPB. So they've been very busy these last couple months since we last met here in Q4. So I wanted to give you guys an update on some of the things we're seeing coming down the line from them. Last week, they dropped their final rule on limiting credit card late fees. What this does is it lowers the safe harbor for credit card late fees, which is currently $30 or $41 for a repeat fee. And it lowers both of those down to just $8, flat $8. If you watched the State of the Union, you heard President Biden reference this in his State of the Union address. He said we're lowering credit card late fees from $32 down to $8. That $32, that's actually the average credit card late fee in some of the data that CFPB collected. So the way that the regulation is kind of laid out is that credit card users can charge a late fee that represents a reasonable proportion to their total costs incurred. So you can charge a late fee, but it's got to be proportional to the cost that the issuer takes on in collecting that debt. And that safe harbor is the amount that is kind of presumed to be proportional. So a lot of people were below that $30, but not a whole lot. I think we're above it, because if you go above it, then you've got to be able to prove that your costs are proportional to your fee amount. So it's lowering that safe harbor from $30 to $8. Now, in terms of applicability to credit unions, the rule only directly applies to credit card issuers with over 1 million active cards, which is probably everybody on this call is well below that. But it's one of those things that is going to impact the big banks more directly than our credit unions. However, we know market effects, right? If everybody else is charging an $8 late fee for their credit cards, and there's these headlines and these stories out there about how the credit card late fee limit has been lowered down to $8. They never reference this, this only applies to $1 million active cards. We don't want to be, the only one in the market, charging this $25 late fee. So, market effects can have an impact here. Reputation risk, we have to take all that into account when looking at our fee schedules and what we're going to charge. Now, I will say on this, a couple of chamber of commerce groups got together with the banking trade associations, and they filed a lawsuit to keep this from being implemented. That lawsuit dropped about 48 hours after the final rule was published. This was widely expected. If this goes the way other things have gone, this will wind up in court, and a judge will probably issue a stay to delay implementation of this rule. So as it sets right now, this is set to go into effect 60 days after publication in the Federal Register. So we're looking at probably sometime in June, but there's a pretty good chance with pending litigation that will get delayed a little bit. So takeaway for you guys, I think review your credit card late fee, look at your amount, what you're charging, look at what your revenue is. If you can, try to estimate, kind of look at what your collection costs would be. And then make a plan ahead. If this goes into effect and you saw, all these competitors lowering down to $8 for their credit card late fee, what would you do? What kind of actions would you take? Always good to kind of plan ahead there if we can. All right, but of course they aren't done yet. We know we also have some proposed rules right now on overdraft and NSF fees. You guys probably know about these. I won't belabor these too much. The proposed rule on overdraft fees would set a benchmark amount, kind of like that, similar to that safe harbor in the credit card late fee. They proposed 4 possible amounts: $3, $6, $7, and $14. They will pick one in the final rule, and that will be the benchmark amount. So same sort of deal where you could charge a higher overdraft fee, but you would have to be able to justify it, show your costs. Like the credit card rule as well, this would only apply to large financial institutions. In this case, it's actually $10 billion in total assets. So I think only about 20 credit unions nationwide actually fall into this category. But they specifically say in that rule, we're going to monitor market impact, and we may lower this threshold in the future. So they are already setting this up for, even if it's just 10 billion today, they're going to lower that threshold and apply it to more and more people in the future. They also have a proposed rule on NSF fees. And what this would do would basically classify NSF fees as abusive. In this context, an NSF fee is a fee for a transaction that is declined instantaneously or nearly instantaneously on debit card, ATM, and P2P transactions. So if someone goes out and they swipe their debit card and that charge does not go through, they start saying, we are, financial institutions, you're not allowed to charge a fee for that instance. I know a lot of credit unions, a lot of banks have been doing away with this type of fee over the years. And so my takeaway here for you guys would be to, review your NSF fee practices. First of all, see if you are still charging this, this type of fee. If you are, I would certainly consider eliminating that, eliminating that fee. It seems like they're well on the road here, going down the road to making this particular fee a thing of the past. And I think that, coupled with the NCUA looking further and further into this as well, we kind of see the signals of where this is going. So on overdraft, always good to examine your fee amount, your revenue, plan for possible market shifts. Kind of like with credit card, if we saw everybody else lower their overdraft fee to $7 or eliminate it altogether, what kind of actions would we take? All right. And so we have, a final rule, we have a proposed rule, and we have some, a couple things we can see some signals on what they might be coming for next. This I thought was interesting recently. They had a blog post showing that they issued an advisory, that's not a blog post, sorry, they issued an advisory opinion recently saying that pay-to-pay or convenience fee charges were prohibited under the Fair Debt Collections and Practices Act. So what this is if, some of you may use this service, Magic Writer, Message Pay, similar type services. Member calls in, they want to make a payment with their Wells Fargo debit card. We can collect a payment through this type of system, and there may be a fee for that service. The CFPB's advisory opinion says that under the FDCPA, those types of, you have to pay a fee to make a payment, or these convenience fee type charges are prohibited. Now, important note here, The FDCPA only applies to third-party debt collectors. Credit unions collecting on your own debt, you're a first-party debt collector, and so you would not be subject to this advisory opinion at this time. You can still use services like Magic Writer and Message Pay, anything that allows you to take payments, and you can still charge a fee for that service. However, I will say that we certainly have seen the Bureau in the past expand out, right? They will say, all right, this practice is unfair, deceptive, abusive in this particular context. And then later, they will open that up and say, all right, now it is also unfair, deceptive, or abusive in these other practices. So if you are using, a type of service like that, I'd say that, just take a look at the overall structure, take a look at the cost, what you're charging for a fee, that revenue that's bringing in, and just flag this as one that you may, be looking at in the future at some point, evaluate as what could become a target next for the CFPB if they decide to take this beyond the scope of the FDCPA. All right, and lastly on the Bureau is they seem to be setting themselves up for their next battle in closing costs. So March 8th, just last week, they had a blog post called "Junk Fees Are Driving Up Housing Costs. The CFPB Wants to Hear from You." And they note that they are monitoring market trends, as they say, in discount points, in lenders' title insurance, and credit report fees. They view these three things in particular as areas of concern. They're looking at discount points as just they've seen the overall rise in use of discount points. And that kind of makes sense considering where mortgage rates are and where they, have been in the past. But on lenders' title insurance and credit report fees, what they kind of are saying in those areas is these are things where consumers are charged for them and there's not a lot of competition, right? They typically are things that the lender will select who does these title insurance. Lenders will select which agency they get the credit report from, and they just charge a fee and pass that along to the to the consumer. And CFPB is looking at these as possible areas where they may look at collecting some future data, maybe issue some rulemaking. They kind of have their full slate of tools in the toolbox that they use, but this does seem to be an area where they are looking at possibly coming into next. So we're going to keep an eye on this. We're going to keep an eye on things coming out from them, whether it be speeches, requests for information, rulemakings. But this I have a feeling might be the next area where they look at in terms of their continued war on fees. Any questions on CFPB things before we turn over to the Federal Reserve? All right. We will roll along here. Just a note for you guys, and some of you may have used the Fed's Bank Term Funding Program. As of March 11th, 2 days ago, that program has closed. So it's crazy to think that this time last year, I think like yesterday last year was when things really like blew up. We were watching, Silicon Valley Bank, Signature Bank, failing. There was this, real sort of crisis in the banking world. And as you remember, the Fed launched this liquidity source, the Bank Term Funding Program, a way for financial institutions to get some liquidity. This was always designed to be a one-year program, really a 1+1. So you could get loans advanced for a year, and then you had a year to sort of pay everything back. So we are now past that one-year point. They have closed that program. They're not making any new loans. Any existing advances have a term of up to a year to be repaid. So for your credit unions, impact, if you had added the Bank Term Funding Program to your liquidity policy, your contingency funding policy, or any of your related procedures for there, you'll probably need to update those documents. And a good point, I think a good time to look at your sources of emergency liquidity. whether it's a line of credit at another financial institution or a corporate credit union, whether it's the NCUAs, CLF, whatever you have as your liquidity sources. One is going away here, so we want to make sure that we have enough sources should we need it. All right. This time of year, we have been, very busy in Richmond here over at the General Assembly. I know a lot of you on the call joined us for Credit Union Day over at the General Assembly, which we appreciate. And the General Assembly has wrapped up their session in terms of the House and the Senate. And we're now in what's called the veto period, or the veto session. So they have passed all the bills that they're going to pass. Everything is over on the governor's desk now, and he has 30 days to decide what he's going to sign, what he is going to propose some changes to, and what he's just going to veto altogether. So we always use this time to kind of look at what might be coming down the line for possible impact on financial institutions. As you may know, anything that the governor signs won't go into effect until July 1st. So some of these things that we're going to talk about today could change slightly. It's possible, or not apply at all. But we didn't want to wait till June to give you guys the preview of what's going to be in effect July 1st. So the first is HB 692. This is kind of sometimes being known as Larry's Law. This is an elder financial exploitation bill that will give your credit union some additional powers to contact some people if you suspect a scam or elder financial exploitation. So one of the things that this does is allows you to list trusted contacts on your account for elderly or vulnerable adults. So if your member is 60 or older, or they are over 18 and incapacitated, you can allow them to submit a trusted contact. What a trusted contact is it's not a joint owner. They're not a beneficiary. They're not an authorized signer. They are just a call in case of weird situation. It is something where if usually it would be a family member, most likely, but it could be a caretaker or someone else. And it's if you suspect something is going on, we can call this person and convey that suspicion. So I will say there's nothing stopping you from doing this, right now, but this is now, kind of written into the code as an option. So this is something that we've seen gain some traction in some other states, and Virginia is kind of jumping on board here as well. So it's just someone you can contact. Now, this is interesting, I thought. So in the bill, they write out that if the financial institution, if the credit union suspects financial exploitation, you can contact these people and convey your suspicion. So trusted contacts, obviously, that's the purpose of it. But you can contact joint owners, authorized signers, or beneficiaries. You can contact agents under a valid POA, which we probably have already, had the ability to do. And then this last one, I copied and pasted this directly from the code section. But what this basically says is you can contact a family member or someone you know to be reasonably associated with the elderly or vulnerable adult. This is kind of a last resort. If you can't make contact with a trusted contact, there's no POA agent, you can't reach a joint owner or beneficiary, you can contact a family member. Now, this is something that some of you may have run into this situation in the past. You've got someone, they're involved in a romance scam or a wire fraud scheme, whatever the case is. You might have had a situation where you can say, man, this person, I know what's happening here. I can't get through to them. Their daughter is a member here at the credit union, would love to be able to just call her and say, hey, can you talk to your mom? Something's going on. Well, this gives you an avenue where, now you can do that. So it opens up the list a little bit in terms of people who you can contact if you do suspect, elder financial exploitation. Good question, John. And I will cover that right here on the next slide as we move to it. Impeccable timing. All right. So John's question was about training. Do we have to apply do we have to do training? So the answer is kind of yes and no. Officially, in the code section, it says that the financial institution may provide training. It doesn't say shall, it says may. So you do have the option. However, there is a safe harbor that limits the liability for credit unions and for staff if there's any actions that come out of you making this disclosure or reporting this financial exploitation. And that safe harbor is contingent upon you providing the training. So you don't have to, but I think it's a good practice to, because it gives you some liability protection. If you call someone and say, hey, we suspect this might be going on, something happens, one thing leads to another, they're threatening litigation or something against the credit union, against the staffer who made that call. If your credit union has a training program in place for your employees, there's some additional protections there. They have this safe harbor. They don't want credit unions to be afraid of liability and to not be making these calls. So good practice to have some training in place there. I will say, when you do make those calls, there's nothing that you have to provide. You can just say, hey, we suspect something might be going on. Can you talk to them? You don't have to provide information about what's going on. You can limit it to that if you want to. You can provide more, but you can limit it if you want. And as for the training, that safe harbor in terms of what has to be in the training, everything mirrors what already exists under the Senior Safe Act. So right now in the Senior Safe Act, it says similar structure. It says, we want you to provide this training. You get a safe harbor if you do it. The language about the contents of the training was pulled directly from that Senior Safe Act. So nothing really, brand new here. I think it's just making it, codified, here in Virginia. And most importantly, there is no mandatory reporting. The original version of this bill required reporting any elder financial exploitation or suspected elder financial exploitation of any dollar amount to local law enforcement, to APS, and to the FBI. We were able to explain to the bill sponsor why that was not the best situation, and they made some changes. And so now the language in the bill, in the law, does reflect, does talk about reporting, but it's the financial institution may report to these agencies. So there's no mandatory reporting. Just like now, you can report to the APS or local law enforcement if you want to. All right. I know that's a lot there, but any questions on elder financial exploitation before we just look at another couple bills here? And I will say that, in terms of what we expect the governor to sign, that bill in its final form, passed, I believe, unanimously out of both houses. So would expect the governor to sign that bill. All right. Next one here is HB 184. This is just one additional little roadblock, one additional speed bump in the process. But if you are foreclosing on a property from a secondary lien position, what this bill says is you have to submit an affidavit saying that you sent monthly statements to the person, to the property owner, for every period that you're trying to collect money on. They don't want collectors, popping up out of the woodwork, not having sent any kind of paperwork for years, and then all of a sudden foreclosing on the house and saying, hey, you owe all this money. So what this basically says is you have to submit an affidavit saying that you have been sending statements to the property owner. And if you haven't been sending the statements, then you can't try to collect that money. So it's one additional affidavit is part of the process, and a little bit of a headache here. Now, the good news is that original lien holders, we work to get this exemption in. Original lien holders are exempt from the requirement. So if you made the HELOC or the home equity loan, you're now foreclosing on that, have decided to foreclose on that position. All this extra affidavit and stuff would not apply to you in this situation. We also have, as it's written right now, specifically state chartered credit unions are also specifically exempt from this. We are working to add federally chartered credit unions. Much to our chagrin, we had language ready to go. We had proposed it. It was in there that would exempt both state and federal credit unions. And then the 11th hour, the Department of Legislative Services decided to redraft this bill. And they said, oh, we're going to exempt credit unions as defined in the Virginia State Code. Well, that definition that they chose to use only applies to state chartered credit unions, not to federal. So I mentioned before how the governor can amend these bills. We're working with his office to try to get him to amend this bill just to specifically add federally chartered credit unions. Most federally chartered credit unions would be covered under the original lien holder exemption, but we want to go belt and suspenders, as we like to say in compliance world, and make sure we're fully covered here. So we'll keep you posted on that, but hopefully I can report back in about a month or so that all credit unions are specifically exempt from this new affidavit requirement, which is just a pain. All right, next slide. And this is one to keep an eye on for your HR teams. There's a bill that was passed that would prohibit asking candidates for their salary history or using salary history to determine wages. And I think a little bit of a bigger deal, it requires all employers to disclose a wage, salary, or salary range in each public or internal job posting. Something where we've seen a lot of states move this way towards, more wage transparency for possible jobs. A lot of employers are choosing to do this on their own. This would make it mandatory. I will say, don't go rushing off to do anything on this yet, because this bill passed predictably on party lines. And I think there's a pretty good possibility that this could be one that the governor chooses to veto in his veto session. So we'll know by April 11th if he does sign it or not. And if he does decide to veto it, there is no way that this would get that veto would get overridden just based on the way it was passed. So I don't know if this is going to come through or not, but we always keep an eye out on employment bills that affect credit unions, not just credit unions as employers. So we'll see what happens on this one. All right, next slide, Mary. All right, and I think last thing for me here is I wanted to highlight this for you guys if you didn't see it. This I thought was interesting. So this was back in January. There was a tweet that went out about Georgia United Credit Union that started to, go viral. And what this tweet says, you can see it there on the right, and it says, hey, Georgia United Credit Union updated their user agreement. They now monitor your account and block any purchase of guns or ammo. You can't buy a gun with your own bank account if you bank with Georgia United Credit Union. Everyone should cancel their accounts. And, went on kind of on and on about that. The tweet went pretty viral. They racked up, I think, almost 250,000 views. Naturally, everybody started, jumping in and replying, how can they do this? Things like that. So I want to explain what happened here. So that screenshot that they have, you can see how it says the following types of payments are prohibited through the service. So this is a P2P terms and conditions, like Zelle. If you use Zelle or Pop Money, similar type service, this is the terms and conditions for that service. What the credit union had done was they had this survey, these terms and conditions on their website. Basically, they had taken the standard terms and conditions from their P2P provider, and they had posted that on their website, which would seem like an innocent enough and innocuous, probably good thing to do to make terms and conditions available to our credit unions. But it opened them up to this screenshot. Of course, this is presented without the context of this only applies to P2P transactions. You can't use Zelle to buy a gun. But it's framed as this is the credit union's internal policy on all of their transactions, and you can't use your money from your credit union to buy guns. You can see here in the screenshot that one of the prohibited things is prescription drugs, right? Obviously, the credit union is not saying that you can't use your money at the credit union to buy prescription drugs. But when presented without context, as is often the case in social media, this is kind of what happened here. So my advice to you, just based on this, would be that if you use Zelle or another P2P provider, it's very, very likely that you have this type of language in the terms and conditions for that service. I looked at Zelle, I looked at Venmo, I looked at PayPal. They all have this similar type of language. So if you use this type of service, what I would advise is on your website or on your mobile devices, link to the terms and conditions on their website. Rather than trying to take their terms and conditions and post it on, your sites as your own. So that way it's you're just linking to their terms and conditions. It's clear that these are their terms and conditions and not the terms and conditions, of your account. So unfortunately, in today's day and age, it's impossible to totally mitigate this type of reputation risk, but just something that we saw and then wanted to flag for you guys as not really a compliance thing, but just a good risk management tool. Something to take a look at if you do P2P. All right. With that, unless there are any questions, I will turn it over to Vanessa. Vanessa, like I said, helps Jay manage the hotline, and she sees a lot of stuff coming in. So Vanessa, anything you want to share with our credit unions here? I know we've continued to get a lot of questions about small estate affidavits and anything else that you'd like to see that you're seeing coming through on your end.
Yeah, I thought that would be a good topic to discuss just because it's very common. It pops up a lot, and before I kind of go into it, I I do want to point out that if any of our members, are looking at a document, some kind of probate or estate document or some kind of affidavit, and you're unsure if it's fulfilling the requirements, for a small estate affidavit, or if you're unsure what that document means, please, I encourage you to reach out to Jay and I, and so that we can, help you take a look. A lot of the forms that you'll see for small estate affidavits and the probate forms, they'll look very similar, suspiciously so. Even the same font sometimes. So just keep in mind that there are many different court forms, and it's really important to take a look at what's inside that document. So before I kind of go into what the requirements are for a small estate affidavit, just a reminder that POD, payable on death designations, and survivorship, that really is trumps the small estate affidavit, if you will. That passes automatically. For accounts where there is no POD or survivorship designation, you can have what's called a certificate of qualification from the probate court, which would give usually it's a family member of the deceased customer. Usually, a family member would have access to be able to look at the accounts and withdraw money and disperse money and all of that. But for situations where the estate is small, if it's under $50,000, Virginia allows the family members of the decedent's the life to go ahead and disperse funds without having to go through the probate process. So if the member's family approaches you with an affidavit that they're trying to use to be able to avail themselves of this this procedure, then the affidavit does need to have certain items in it. So number one, it has to say the date of the death. There has to have been at least 60 days between the small estate affidavit being signed and the decedent's death date. The affidavit has to have language stating that the entire estate is less than $50,000. So for if you look at the bank account or if you look at the account that's open, and there's more than $50,000, you automatically know, okay, well, we can't use the small estate affidavit. Obviously, there's more money than $50,000 in this account, so they'll need to obtain, go through the probate process, and obtain that certificate of qualification I mentioned earlier. The affidavit also thank you for that. That's perfect. So you'll see on that Virginia code that list of what is required there. It's important that the affidavit does contain all of that information. If there's been situations where you'll see something called a list of heirs or a real estate affidavit. Those are affidavits that serve different purposes. And so often your member's family will have, many of these forms, and they might come to you and not know which one you need to be able to give them access to this account.
Hey,
And then,
Vanessa, quick question on that.
yes.
I know a lot of credit unions will direct people to the local circuit court as a place where they can get this affidavit. Do you see any issues with the credit union if they have an affidavit, like a blank affidavit, providing that to a family member and saying, hey, fill this out and bring it back to us? I know we don't want to get too involved in guiding them down the process, but we do get that question sometimes about if they need the affidavit, can we give them the form? Any thoughts on that?
So I would actually recommend doing like you said in the beginning, and sending those family members to the circuit court. They likely have to go there anyway. There's there's a lot that needs to be done to tie up loose ends. It's not like you'll be saving them a trip.
Right.
And then on top of that, forms can change, certain, the law can change, we could have another requirement added, and so you don't want to get into a situation where you're having these forms available and they're, legally insufficient.
Gotcha.
I think it's just way better protocol to send them on to the clerk's office, and that way, if the form is out of date, it's on the clerk and not on the credit union.
Yes.
Yeah, and I did want to point out the powers of attorney. Absolutely great to have, but the powers of attorney, they are void at the passing of the principal. So you might, in that stack of documents the family member gives you, you might see a power of attorney and think, oh, well, they have a power of attorney. Of course, that gives access, but unfortunately, no powers of attorney. As soon as the client passes away, the power of attorney is no longer, no longer able to be used. And I've got a couple of examples of these affidavits that I could share on my screen.
Yeah, that'd be great.
Oh,
I am.
uh,
There we go. We'll unshare, and then you should be able to use that screen share screen at the bottom.
I don't think I'm a host, but
Oh, okay.
you've got the
We can email them around to the whatever you want.
yeah.
We can
Oh
email
yeah,
the group
that
after
would be
the
great. Yeah,
session.
I think that would be perfect. And again, I just want to recommend that if anybody has any questions about a forum that they're unfamiliar with, or you think that all the requirements are there but you're not quite certain, we're very much happy to take a look and help guide you. We know that these forms can look similar, these affidavits. So go ahead and reach out to us, and
Gotcha.
we'll be happy to help.
One more question for you, Vanessa. So you mentioned at the beginning there, if someone, family member comes in, wants to do this affidavit process, if there's a POD beneficiary on the account, that kind of stops everything, because that POD beneficiary is the person who has who's now is the owner of those funds, basically.
Yes. Yep.
We do run into, I think sometimes I've heard this before, and we experienced it when I was at Call Federal, was this kind of awkward where you want to tell the person that there is a POD beneficiary, but you don't want to say, hey, John Smith is the POD beneficiary now, so this $200,000 belongs to him, and you don't want to cause any kind of more drama in the process that there needs to be. How do you feel about credit unions saying, hey, there is a POD beneficiary? Can we say the name of that person, who that is, to the family member who may be here in front of us and isn't that person? Any thoughts on how to handle those types of situations?
Yeah, so I think in that situation, again, I'm gonna plug the hotline. If you're ever in that tricky situation, especially with when you're dealing with members who have passed away, always, feel free to give us a call, because my answer is actually it kind of depends.
Yeah.
If the family member gives you that qualification from the probate court showing that the family member is, administrator or executor of the estate, that document really empowers them to have a lot more information than the small estate affidavit might. So, it in certain situations, I think it would be fine to release that information, but it really depends. And I think above all, just urging caution is good practice. I think it certainly an explanation of, oh, these funds cannot be dispersed because there is a POD designation already on the account, and then kind of stop there without providing the name. I think that would be the most prudent. But again, that letter of qualification does give court-ordered access to financial accounts. So if the family member has that letter of qualification, then they'll be able to find out that information.
Gotcha. No, that makes sense.
Yeah, and I can also see where that would be a very awkward situation if you're trying to, withdraw, all of your all of the funds, and you see, oh, dad gave that all to the sister. Yeah,
Yeah,
I could see that
most
running.
of us here can probably recall a situation of an ex-girlfriend or ex-spouse, or those types of things still being POD beneficiaries. It's you get into some weird situations for sure.
Oh yeah. And I think that's actually all I had to talk
Great.
about today. I'm very jealous of everybody's time, but I'm so happy that I got to talk today and to share some knowledge.
Thanks for being here. And last few minutes here, while we have, I just wanted to open up to the group. If there's anybody has any topics for discussion, any questions you have, we might be helpful with. Any weird situations, things you're hearing from NCUA that you're questioning, or anything like that. If anybody has anything they'd like to share, please feel free. Sound of silence. We love it. Everything's buttoned up. We got great policies and procedures. NCUA is not giving us a hard time about anything. What a world. What a world to be in. All right. Well, with that, we will, I'll let everybody go here. We will send out to the group, everybody who registered, we'll send out the slide deck that I presented, as well as some of those affidavits. We'll get those from you, Vanessa, and share that with the group. As always, we do these on a quarterly basis. If you all have anything that you'd like to hear more about, any topics, please let us know. We're planning some more individualized sort of sessions kind of in between. I'm working on one right now that will be coming up, kind of focusing on litigation trends, that some of these class action lawsuits going around against credit unions and some of the things that you could do to protect yourselves there. So be on the lookout for that in the next few weeks or so. Until then, thank you all so much for joining. Thank you, Vanessa, and it's good to see everybody. And if there's anything we can do in the meantime to help, please feel free to reach out to the team at Woods Rogers, reach out to me, reach out to anyone at the league, and we'll do what we can.
Thank
Thanks
you,
so much.
JT.
Hope everybody has a great day.